Good evening, everyone. I'm Susie Garup. Tyler's off tonight. Topping our news, uncharted territory. That's where the S&P 500 index went today, crossing 2,000 for the first time ever in intraday trading and marking the latest milestone in the stock market's historic bull run. Corporate takeovers, which we'll have more on in just a moment, and hints of more stimulus from the European Central Bank helped stocks hit that psychologically important number. Now, adding to the enthusiasm, a report from the Chicago Federal Reserve, which shows economic activity expanding at a rate above its historical trend. By the closing bell, the Dow rose 75 points, the Nasdaq added almost 19, and the S&P 500 was up 9.5 points, closing at 1997.92. Dominic Chu has more on the 16-year journey for the S&P 500 to cross that 2,000 mark.
February 2nd, 1998. Remember what it was like back then? The average price of gasoline was $1.06 a gallon. Today, it's $3.47. The S&P 500 Large Cap Stock Index crossed 1,000 for the first time. Today, it crossed the 2,000 mark. The mid to late 1990s were all about tech companies, but today, it's more balanced.
It's interesting if you look back into the 1990s when it was kind of a dot-com era, if you will. A lot of high-tech companies, a lot of high multiple companies. I think the market is probably more spread out amongst other sectors, and I don't see that true leadership in any one particular sector right now.
Since the S&P 1000 mark, the best performing sector has been energy. That's stocks like ExxonMobil and Chevron. As a group, they've nearly quadrupled in value. As for the worst performing sector, it's telecom stocks like AT&T and Verizon. As a group, they've lost a fifth of their value. Telecom is also the only sector that has lost value since February of 1998. Now, when it comes to individual stocks, take a look at beverage makers like Keurig Green Mountain or Monster Beverage. Back then, they were worth just pennies per share, and today they're among the largest companies in America. Meanwhile, bank stocks like Citigroup and insurance stocks like AIG have been the worst performers. Over the next few months, some experts believe that the market can continue higher if you pick the right places to invest.
I think that it's really going to be consumer discretionary and information technology that's really going to propel this market higher towards the end of the year. More offensive sectors rather than the defensive sectors in something like utilities or telecom.
Of course, there's still a large concern that a stock market at record highs is ripe for a pullback. Still, though, S&P 2000 is a nice way to benchmark for many investors, a big moment in the stock market. For Nightly Business Report, I'm Dominic Chu.
With us now, we're happy to have Mohamed ElErian. He's Chief Economic Advisor at Allianz. So nice to see you, Mohamed.
Thank you, Susie.
So we have to start with the S&P at 2,000. It's a nice round number. It's a milestone, and a lot of investors are talking about it. And the one question that kept coming up today is this the top? Should we start preparing ourselves for a correction? Is that the next thing that we're going to be worrying about? What are your thoughts on that?
So it's a big moment, and we need to understand why we're here. It's interesting because we had a new record high for the S&P. We had the Nasdaq at a 14-year high, despite geopolitics getting more complicated in Ukraine and in the Middle East, and despite weak data out of Europe. And the reason why we're here, you said it in the beginning, central banks are very supportive. The ECB has signaled that it intends to be even more accommodating, and there's a ton of cash coming in from the balance sheet of corporations through M&A activities that is giving the market an extra lift. So as long as these two elements continue, the market is in a good place. The problem is that they cannot continue forever. We need the real economy to pick up. We need earnings growth to get a boost from the top line.
Well, you know, you wrote an op-ed piece this week, and one of the conclusions was that you said that this summer we've seen that the markets have been extremely resilient in the face of these geopolitical shocking headlines. Do you think that investors and the markets will continue to brush off these headlines, these nasty headlines, going into this last quarter of the year? And back to that correction question, might we see a correction?
So they will brush them off as long as the geopolitics does not tip Europe into recession. And this can happen because Europe and Russia are in a game now of sanctions and counter-sanctions, and they weaken both economies. So as long as that doesn't get to a tipping point, then the markets will brush it off. If it gets to a tipping point and Russia and Europe goes into recession, companies sell a lot to Europe and they will feel it. So that's something to keep an eye on. And it's critical because it really is a tipping point dynamic.
So historically, we all know Wall Street history has shown that September is a tricky month. We have a lot of market meltdowns in the month of September. You know, what do you think will be the key issues for stocks and bonds once it's back to business next week?
So geopolitics remaining just noisy and not impacting growth. That's the first thing. Second, central banks remain accommodating. And then thirdly, money continuing to come in. So a big question is, will S&P 2000 pull in more money into the market? Will it encourage more companies to use the cash that they have on their balance sheet to do M&A activity? And remember, some of these M&A activity end up in people paying a lot more for the companies simply because they're doing it for other reasons. They're doing it for tax reasons, or they're doing it for defensive reasons. So they end up overpaying. So these are the issues to look at, Susie.
And we have two big things on the calendar that everybody will be looking at. Next week on Friday, an important employment report, and everybody's going to be watching that given the conversations that the Federal Reserve has been talking about, looking at new data. And then there is an important Federal Reserve meeting in mid-September. At the end of the day, what do you think is going to, those data points are going to tell us? And should investors and business owners be fearful of higher interest rates, or should they actually welcome it?
So first, on the data point, what the market is looking for is solid job growth and, critically, wages that are not increasing too quickly, because that is what would push the Fed into being more aggressive in terms of lifting its foot off the accelerator. So the employment report, look at the wage number. That's a critical number. In terms of the Fed will signal that it's looking that things are a little bit confusing, that is data dependent, but I don't think it will tell us much in September. In terms of interest rates, the hope is interest rates will go up for the right reason. And the right reason is that our economy is getting close to liftoff. That is what the stock market needs. We need a handoff from policy-induced growth to genuine growth.
All right. Well, you've given us a lot to think about going into September. Thank you so much. We really always love having you on the program.
Thank you, Susie.
Mohamed ElErian at Allianz.